Hey, good morning, everyone. Marty Mazzora, November 2019, Friday morning. Going to keep this one quick, I promise. No market charts today. I'll just tell you the market's down a little bit this morning. It's been kind of jumping all over the place. I wouldn't put any weight on anything right now. The powers that be seem to have no stomach for any kind of a market decline. So we get a little bit of a sell-off, and there will be something said about trade with China that will get traders to rush in or trigger an algorithmic purchase of a bunch of shares. So if you're trading this market on a short-term basis, I wish you all the luck in the world. Okay, so the chart in front of you, PWA macro index, that's our own. Received an email from a good friend yesterday with an attachment that was a pretty glowing economic report, and he asked for my comments on it. And it's interesting. It's like a lot of what I'm seeing, frankly, on Twitter. Now, we recently joined Twitter not to comment, although I have a few times, but not looking for followers. It's just, as you know, or as you might imagine, it's often the place where market news breaks. So we like to know what's going on as soon as we can. So Twitter is a necessary evil, I would say, and I can see on there as I periodically kind of peruse the posts. Boy, the bull and bear camps are deeply entrenched on either side of the ditch, and it's interesting just kind of catch. I don't read it all, but in passing, how they can go at each other. If you're at all bearish, it's like a sin, and if you're bullish, according to the bears, you're just an idiot who isn't seeing, the forest for the trees. So I'd like to think that we don't subscribe to either. It's not important to us that we're bullish or bearish. We don't really subscribe to any ideology that would put us on either side of the fence. I will confess that I am an optimist at heart. Those of you who've known me for a long time know that. And but I've sounded somewhat pessimistic of late, not because I want to, but because stuff troubles me out there. That's why we're guarded with client portfolios. So anyway, to kind of paraphrase what my friend sent me, it was just a very glowing report from a team of economists. They mentioned specifically, as all the bulls do these days, the jobs numbers. Friday's employment report beat expectations, revised up previous months. I actually said it was an unambiguously good report. But let's not overstate it. Expectations for Friday's jobs report were actually below 100,000. I don't remember the last time they were that low. And they were surprisingly good. So it's like earnings in the third quarter. Hey, we had 75% of the companies beat earnings. Well, come on. Revenue was disappointing and forward guidance was very disappointing. That's what counts in our view, not whether or not you beat lowered estimates. So same kind of thing with the jobs number. Let me just show you what I sent back to him, just to kind of help him understand my positioning. Here's the PWA index, 86 data points. We're in the red by about 6 points as of last weekend. Going to update it probably this afternoon. Then I just showed our back test. I created this in July of 2017, been doing it every single week since then. But then back tested it at key areas, and we're in the red for the first time since back here right before 2008 and right before the tech bubble burst. And as I've illustrated for you before, once we go in the red, I've told clients before this happened, expect the market to bounce while we are beginning to get defensive, because that's when all the stimulus comes in, as the powers that be fight against what may be inevitable. I don't know that it's inevitable. Maybe the trade war goes away and we turn green again and we don't need to hedge anymore. But this is what we need to do right now. Showed industrial production. Folks, that's an ugly chart. That's the latest. That's IP in America. That's what it looks like before recessions. Durable goods orders. That's what it is. That's what it is ex transportation. That's what it is before recessions. Commercial and industrial loans. That's what it looks like. It's looked like that just a couple of times outside the last recession. Global Purchasing Managers Index below 50 is a global recession. ISM, Institute for Supply Management Services and Manufacturing Surveys, manufacturing in recession. Services head in that direction, but we did get a pretty good bounce. We talked about that here in as well. And then here we are, with somewhat of a concerning look. Cass freight shipments. The Cass chief economist thinks we will be in a recession by the end of this year. I disagree, but I think he has a right to be concerned. Expenditures and freight shipments. Chemical Activity Index, very early stage manufacturing. Looks like it's rolling over. Not looking good. Raw Industrial Index, your coppers, your iron ore, etc. That's what it's looking like. We had China, building ghost cities, so we actually rose right into the last recession. Typically, you begin to wane when the economy begins to wane. 10 spread, 3-month LIBOR versus 3-month T-bill. That's what it's looking like. That's what it looked like prior to the last 2 recessions. Money market fund assets. You'd think, hey, this is liquidity. That's good for markets. Well, I said that all through here. I'm not saying it now. This is more looking like big money moving to the sidelines like it did before the last recession and the one before that. Okay, then I said, how about some good or not so negative looking stuff? Brick and mortar retail. Remember, it's the consumer that all the bulls are talking about. So here, brick and mortar retail sales, somewhat ambiguous, but of course it's getting hit by online. Online still looking good to me. So that's a good, positive score on our chart. Auto sales, again, not looking like a recession, not looking like a raging expansion, but not looking like a recession either. Consumer spending, okay. Ambiguous 10-week moving average, not so good. So we'll see how that plays out. Consumer income, not bad. Not a recession, not bad. Nice higher low right there. Housing starts, okay, again, not a recession. Housing permits, looking pretty good still. Consumer confidence, not so good. Beginning to roll over. The Conference Board survey, University of Michigan survey, and the weekly Bloomberg Comfort Index has finally broken below my upward trend line. Still not, super scary just yet, but something to be concerned about. Okay, so the consumer, and I could show you more. Again, we have 86 pieces of data that we track every single week. But again, I get it. The employment numbers are good. I'll continue to tell you they're good. The jobless claims are good as well. But let me give you just a little more nuance. We've got to dig before the surface, folks, or we're just not doing our jobs. Here is from the last, little fuzzy, I apologize, but this is from last week's employment report. 61% of the growth came from leisure and hospitality. By the way, that's the lowest paid run of the employment group, if you will. And of course, it is the very first to go when the economy begins to slow. Let me show you, I've shown you this before, I'm going to show it to you again. Let me show you the latest, very recent CEO confidence scores versus the latest consumer confidence scores. Overall confidence and expectations going forward. So the consumer, and we're seeing it in the jobs number, feels good. Still feels relatively good. Not quite as good about the future as they do their current situation. CEOs absolutely, unequivocally do not. Who hires whom, right? What happens if this continues and they're making the necessary cuts? So if and when the employment numbers begin to shake, and I'm not predicting it, but I can see it happening on many metrics, but certainly CEO confidence is probably the biggest one that tells you to look out. Once that begins to break, you are going to see the consumer break in a big way. And if I laid this up, and in the interest of time, I won't do it today, but if I laid this up against past recessions, you see that the consumer confidence seems to hold in it. Well, actually, it's here. Here are these gray areas on these charts. These aren't our charts, but you can see how optimistic the consumer was right up to the end of the last several recessions, right up to the end. But you can see the CEO was getting pessimistic long before the recession ever started. So maybe this has a ways to go. But folks, I think we get into the first part of next year. I think something is either going to break, that this is telling us that there's a break coming, and it's going to hit the consumer. And when the consumer rolls over, folks, make no mistake, the stock market rolls over, regardless of tweets and everything else that's going on. But it doesn't. But if we can somehow, there are some other metrics out there that are beginning to look like maybe they're bottoming. The bulls are pointing to those. If that can develop and that can gain a little traction over the next couple of months between now and the first part of next year, and we begin to see some optimism amongst the business, decision makers, then maybe there's a better narrative going into next year. Right now, there's enough messy stuff out there to keep us very concerned and somewhat defensive. And as I've been showing you under the surface, I did it in a blog post just a little bit ago and in yesterday's video. If indeed we do roll over, I think it's exceedingly messy when we start touching what's down below and impacting it with a slower economy. Thank you, as always, for watching and listening. Hope you have a wonderful weekend. Talk to you again soon. Bye-bye.